Rakesh, I'm going to start with you on this one. Most people in the audience have over 10 years in terms of time with regard to making their wealth work and grow for them. In your opinion, and with the years of experience that you have in this business of wealth management, what do you think or what should be one's ideal asset allocation if you're looking at money that could be invested for a 10-year period, over a 10-year period?
See, the mere fact that you have monies for long periods of time means that you can look for return objectives upwards of 15%. So Feroze, I think, mentioned to us that the inflation is in the region of about 10-12%. So getting a return of more than 3 to 4% more than inflation is not an unreasonable objective to have. And 15% objective also leads to quadrupling your money in about 10 years. And the asset allocation that can directionally get us there is in the region of about 65% in equity and about 35% in debt. The whole idea is that if you are, if you put everything into safe assets, you'll get a 7-8% kind of return, which means that you are actually depreciating your money. You're not taking risk, which is market risk, but you're depreciating your money in terms of the inflation eating into it. So there's no free lunch, unfortunately. Yeah. So either you have a certain risk of money sort of diminishing in terms of purchasing power, or you take some level of market risk and ensure that you safeguard your money, in fact grow it. My sense is 65% equity is reasonable.
I think one thing that historically has kept Indians away from equity is the fact that it carries market risk. And as a nation, we're generally a lot more risk averse than most other developed countries, if I may use that word. What brings me to my next question is that most people still get put off with equity as an asset class because of the risk it carries and the uncertainty of the returns that go with it. So you could have a year when your equity markets are on a breakout, which we are now seeing in the last 3 months, and then you might have years or extended years of underperformance of equities. I mean, of course, we've got to make sense out of this and look at it as a 10-year investable time horizon. But reality is that most of us still freak out about equities because of the inconsistency of returns, right?
Well, that's the nature of the beast. The fact is that nobody can take away and predict volatility, right? And because there is volatility, there is return, right? So you don't take the risk, you don't get the return. It's up to you to choose whatever objectives that you want to choose, and therefore have an asset allocation which will work for you.
Yeah.
And nobody can say that, hey, this is how it's going to pan out or not pan out. There are risks in it. Now, if you look at risk, we talk about risk, we don't measure it, right? The simple thing like standard deviation is a measure of risk. When you invest money for 3 years, the last 18-20 year analysis shows that the standard deviation is 13%. But if you do it for a 10-year period, the standard deviation drops to 3.5%. So all these numbers are here. They need to be just looked at, and then take a call which is on the basis of data and information, and be comfortable. Learn to be comfortable with volatility, right? And that's the only way that you can make the return.
Feroze, I'll take a cue from that, and let's talk about historic data that we have, which of course Rakesh alluded to as well in his answer. Historic data show, what does it show? Does it show that 12 to 15% sort of returns are realistic in nature to begin with? We know inflation is 12% for most HNIs, but 15%, is that even a realistic number, or is that a flash in the pan?
See, if you look at data, one is whenever you look at data, you're looking at living the experience of 25-30 years on a simple Excel sheet. So the purpose of looking for data from the past is to live the experience. Nothing is to say the next 25 years could be dramatically different. But ignoring the last 25, might not be the great starting point of your strategy. You might want to give some emphasis to it, not the entire, but if you look at it, it is clear that you have two layers of value add. One is what the market does, correct? Market historical averages of large indices is about 14-15%. Mid-cap indices, which actually is smaller companies which grow to become the larger ones, have 3-4% more, right? So you have 16-17% historical mid-cap indices performances. Now lastly, you also have a mutual fund manager who is another layer of professional who tries to outbeat the market or reduce the risk for you. So you have three sources from which you get it, get the return. So what is 15% a realistic number? In my opinion, yes. And to my mind, if an investor understands this, the risk is not in the asset. The risk is in your action. What do I mean by that? In 10 years, the worst 10-year investor, if he stayed the course for 10 years, in a mutual fund has made 11 to 12%. Worst 10-year investor. And the luckiest 10-year guy has made 32%. And the average is 23. Now, if I plant a tree, or I plant a plant, however we say it, and remove it every day and check whether it's grown and plant it back, it's unlikely that it will grow. So the action is what? If I don't stay the course and quit the game at the end of 2 years, and if I actually stayed the next 8, I would be able to get the return. So you'll have to go through the painful short term to reach the long term, is the point being made. Point 1. Point 2, finance is a stream which progresses extensively. Last 10 years, 10 years back, there was an instrument which protects against market risk in India, launched on 28th of February 2008, much before the 2008 crisis. There is an instrument on an NSE platform, not by some small company, by a platform as strong as National Stock Exchange, to insure you against market risk. What is this instrument called? Has it reached the wealth management client? The answer is no. Why isn't it reached? Still a question unanswered. There's no commission to it. Maybe that's why it's not reached, to be honest. It is called a LEAP, L-E-A-P-S. Will the treasuries today, as we speak, have they used it for the last 8 years, 9 years, if not all the 10 years? The answer is yes. So if you use the finance concept coupled with a behavioral pattern which is commensurate to the time frames which I first initially thought, this combination brings down risk considerably. One is an emotional and inward-looking action of inaction, and the other one is outward-looking, saying, what are the new instruments which are available? Globally, LEAP is a very popular instrument. US, I think it's upwards of 25 years of existence. In India, it's 10 years, and people have not examined the usage. You might be wanting to learn it today for its application, like Rakesh sir says several times, that learn it today so that you can swim sometime when you are in deep water.
So I think it's fair to say that equities over a longer period of time is obviously far less risky than it is in the short term. But I'm just going to play devil's advocate here, right? So while you have all these mutual fund ads which constantly reinstate time and again is that past performance is no indication of future performance. And I think we've deliberated over this time and again that real estate, which has created enormous amount of wealth for a lot of people in the past, is unlikely to do the same in the future. So why the conviction that equities is going to create the kind of wealth and the kind of numbers that we're talking about? So your rationale for why equities, or why you're so bullish on equities, Indian equities in particular, for a 10-year period, 10-year plus period?
Well, I think that Feroze has somewhat given us the answer, which is that the average returns have been, excellent in equities. We've also seen in the presentation of the AV that was put forth over there that the returns on real estate in various cities for the last 25 years have been in the region of about 12%. So 23% is a number which is far greater than 12% on a 25-year period. That's point 1. Point 2 is that unfortunately real estate has seen some wonderful days and is at this point in time in a phase where it is correcting itself. All asset classes go through, very bad periods and periods of excesses. And after they reach periods of excesses, they then correct themselves. Unfortunately, real estate is in that period of the excesses being corrected. On the other hand, equity for the last 10 years has given an average return, or the index has given last 10 years the average return of about 6%, which means that it had a low period and therefore is likely to do well. And real estate, which had done exceedingly well, is likely to correct itself. And therefore, for the next several years, it is you need to make a call as to what is likely to do well for you. Asset classes are cyclical. All of us know that, and here are the numbers playing out for you. So look at the numbers and take a call in terms of what is likely to do well for you. I believe that equities should do well, and more importantly, I think the economy is on an upswing, and corporate profits have started improving. Capacity utilization has reached levels which have not reached in the last several years. Capex is coming back. There is a sense of positivity in the economy. When you have that positivity in the economy, it rubs off on profits, and then it rubs off in the markets as well. So my sense is that the markets should do well, and it should be an opportune time for all of us to look at this opportunity in our portfolios.
So while I do agree with you, Rakesh, on that, there are some things that still make us apprehensive. I mean, we celebrated 72 years of independence. The rupee was hitting 70 against the dollar, one of the worst performing currencies in the world. Sure, we have inflation that may seem like it's under control, but growth also may struggle 2 quarters down the line. Beyond that, I think what troubles retail investors and investors or institutional investors is the fact that the Nifty may look elevated today, but most people in the audience who've had portfolios for the last year or two are actually down 20 to 30%. So a lot of your mid-cap stocks are still trading at a 40% discount. Now, optically, while things are looking like they're getting better, one layer down, things still are unsettling, and I think as an investor that worries most people. So while we keep celebrating a new high on the index, and I do this pretty much every morning, the worry is that you still have a whole lot of counters that are under tremendous pressure. That impacts your mutual fund portfolio, right? So I mean, of course, that's one side of the story. I do take your point that this asset class should grow, but I'm just trying to address some of those concerns that a lot of people in the audience would probably have, right?
Okay, let me take that. So, Sabina, well, like you said, we are in the 72nd year of independence. Of course, there's one which is a short-term thingy of mid-caps being down. That I'll come to secondly. It's also important to note that in the 72nd year of independence, we are now the 5th largest economy. We have beaten Great Britain, as they call it. It's not as much great now. But this is the first time in the history we have crossed our economic size greater than the country which ruled us for several years or centuries. Is that a point to be noted? 2013, we were the 10th largest economy. Today, we are the 5th largest economy, right? Now, economy, like Rakesh mentioned, that economy is going to do well. It's not a 6 months, 1 year phenomenon. When you have to, investors should always get trends right, not direction. A trader needs to know what's the direction of the market. An investor needs to get the trend correct. Now, if you speak of economy, the obvious first element of economy, growth, is government will spend money. Government is the largest spender. And when government spends, you get a multiplier because it is spending at the lowest strata, and that comes back into the economy. If you actually look at where does government get its money from? Direct taxes, indirect taxes, and disinvestment. Let's keep disinvestment aside. Direct taxes, do we know that last so many years of 68 years of independence, we had 3 odd crores of people paying income tax. In 4 years, it is 6 odd crores. Now, when the direct tax base has doubled in the last 4 years because of the communication of the government that tax compliance is not exemptable, there will be direct tax collections which will go up substantially. Indirect tax, when I buy a bottle of water, I'm paying taxes indirectly, not directly. That is being addressed by GST, right? So people are coming into the ambit of paying indirect taxes. So this will increase government's income, government's expenditure. How will the economy not get propelled? It is the most conservative guy says that you will be 6 trillion economy in the next 10 years. We are at 2.6. Okay. Now market cap, matlab the total value of all the listed companies, has always mirrored GDP. That means 3.4 trillion of market cap is going to be created. Somebody's got to be making the money. Who will is the question. If I'm not in it, may not be. Now you have to manage risk. Now coming to, that's exactly why if you buy products, I buy these 3 mid-cap funds. You don't have a strategy, that is clear. So if you are today in pain, it is but obvious that you have not had a strategy in place. So the only solution to have not these extreme situations on your entire wealth, the only answer we know of, okay, there could be other answers, is to put a strategy in place and implement strategy rather than saying which is the mid-cap stocks I would want to buy. Right? So strategy is a very good solution to cut extreme positions of yours. You will not be partying significantly, you will not be moaning either.
Mutual funds are a lot more boring because you leave it to your wealth advisor. Of course, you talk to him once every few months and you oversee your portfolio once a year. And I know for a longer period of time, boring is better than fun. But Rakesh, talk to us rather about, agreed, equity is the asset class for a 10 plus year kind of time horizon. But what is the best way to play equities? Direct equity, which is very tempting, or would you stick with the boring mutual fund route and, just stay the course?
Well, I'm a boring person, old man. I'll choose mutual funds. Excitement is over for me. So, as far as I'm concerned, if I am a high net worth individual, I'm responsible for large values of money.
Yeah.
Right? Now it's up to you. You want to choose a more tried and tested mechanism to manage your big money, or do you want to play around with it? It's your call. And I strongly recommend a more boring and find entertainment elsewhere.
Yeah, head to Vegas instead. But just comment on that, and Feroze, you might want to throw some light too on this. What is the alpha that mutual funds give you over direct equity? A, and B, there are various ways of determining what mutual fund would fit your portfolio, what product is probably best suited. But generally speaking, a broad-based strategy around what should your portfolio really be?
See, mutual funds, the reason why we pay them a fee is to outbeat my other alternative, which is to say I don't need any help, I will buy myself an index, not direct equity. Okay, so if they actually are being paid, they need to outperform. By which I mean, if Nifty delivers 10,
yeah,
I would expect my fund manager to use all his intellect and research to give me 12, 13, 14. What is that number which is a fair expectation is 4%.
Beat on what the Nifty
on
is.
the Nifty index, which is my alternative if no professional was available.
Right.
Unfortunately or fortunately, 25 years back, you are only 10 people pitching for this job. Now there are 530 funds open-ended who are saying, I'll do the same job for you. There comes the job of an advisor to be able to pick those 6, 7 to have the highest propensity or the probability to give you that 4%. Now comes to the point which you said, like in a mutual fund advertisement, you say past performance is not a great indication of the future, which actually is true. Right? If you see the best performers of the previous 3 years to the 3 years you've invested, they actually are not the best performers anymore. Right? So how do you do it? Fortunately, we are in the business of finance and there are answers, mathematical recognized answers globally to give you the answer. There's a subject called regression to predict future. If I am responsible of thousands of crores of equity money of different people who have taken years to gather it, will I use regressions as my method to understand which other schemes I will buy? I would. As an advisor, I'm duty bound. So point is, out of 530, I need to choose 6, 7, and that can't be on the basis of past performance. There are tested mechanisms of trying to better predict the future. Not perfectly, better predict than the past.
So as close as you can get. Rakesh, then in terms of a broad portfolio design, if you're looking to achieve that 15% returns, what would that ideal portfolio look like or should look like?
Well, as I said, that the asset allocation would be 65% and 35% in equity and 35% in debt. And the products that I would use would be mutual funds in the region of about 60% and something called structured products to about 40%. And that's the
breakdown of the products.
So on the equity side, I'd use equity funds. On the debt side, I'd use debt funds and ensure that there's 40% infusion of structures into this mix.
So I'm not sure how many people over here would even know what structured products means. I know it's picked up a lot of popularity. I know Anand Rathi is one of the leaders in the structured product space. You want to just start by telling us what does it involve, because the word itself could, I guess, bluff people as well, right?
When Feroze is sitting,
he's the man for structured products.
If I talk about structured products, it'll be unfair. So, a man who's created it, the birthright इसी के पास है. तो बताओ.
So structured product is actually a very simple instrument. Why is it a simple instrument? Is because it is nothing but a bond. It is a promise by a corporate to give you a return which is not fixed, unlike other bonds. So the only distinction is, if I buy a bond from a corporate, generally it will tell me that I will get a 9% interest, 8% interest, 10%. A structured product is nothing but a bond, but does not fix your interest, but the interest or the coupon, as they call it in the nomenclature, is dependent on how Nifty delivered the return, for example. So if Nifty did 4% a year or 5% a year, the product commits to you 17% a year. Not a fixed 9, but can give you a variable payoff varying with Nifty. So it is not a debt instrument. Optically it's a debt instrument, but the return it can generate is going to be equity-like. So point one, structured products are products which are bonds which give a variable payoff varying with an underlying, in this case Nifty. Point one. Point two, why are they critical? Why is Rakesh sir mentioning that 40% should go into structures? That's a lot of money, right? Because structures have two attributes which are unique. One is there's no human intervention. I can see television and realize what the structured product should deliver, right? Like in a mutual fund, the fund manager will have to do buying and selling of shares. In a structured product, you know that you have locked in a coupon and Nifty will determine what my payoff is going to be. So there is something called human management. There is something called mechanical management. This is a portion of mechanical management, saying that I don't want any emotions coming into this portion of money. 60% anyways there is a human being doing something. Is it wise to have all 100% when you know we are a statue of emotions as human beings, to put all of it there, right? So 40% goes into mechanical management, 60% goes there. And when you look at structured products, they have the capability to complement equity. So your plan A is mutual fund, your plan B is structures. Plan A, see, on simple things like going to a restaurant, if I don't get a reservation, I have a plan B. Do investments need plan B? Question number one. If so, which is your plan B? Structured product, when we examined 10, 12 possible plan Bs, structured product fit in as a complementary thing as a plan B. Why? Because they deliver a good return when the market delivers mediocre return. When market delivers very well, structure would, in hindsight, seem like a stupid decision, but equity mutual funds would have done very good for you. So there are complementary products. When you so do it, your risk comes down and you get an all-weather kind of a portfolio mostly, right? So like in every match in the team, you have different players with different strengths. A portfolio also requires some degree of complementary instruments, which is what risk comes down with. Of course, structured products being complex enough, at the face of it, if you don't understand it, it's only from a curiosity perspective it can be addressed in a gathering like this. Yeah. But understanding it before you step in is the most important element, and it's very simple to understand if you actually spend an hour. And that, to my mind, is one of the best instruments which has delivered.
Just to elaborate on that, right? So mutual funds usually, because they're linked to equities, carry market risk. What kind of risk do structured products carry? Because there is no free lunch in life.
Correct. It carries risk, of course. To two risks it carries. One is Nifty risk. I assumed that Nifty will at least deliver 4-5%. If you're bullish, that means that Nifty can do 15, 20, 30% also per year. But an advisor can go wrong, a view can go wrong. So if Nifty delivers 5%, you will get the return. So the risk is if Nifty doesn't even deliver 4-5%, then I don't make that 17%, right? Which I wouldn't have made in equity either. Second risk is you will have to buy it from a corporate which is strong enough. Because one is the promise. The second element of a structured product is who is promising. The promiser should be strong enough for the promise to be valid. The second element is called credit risk. The first is called the market risk. If you examine them well and manage them reasonably well, then the value it can create for the 600-700 products which I have seen maturing.
And those risks you anyway carry in your portfolio because you anyway have mutual funds and you have debt products. One carries credit, the other carries market. So it's not like you're adding any additional version of risk. Just a couple of more points in structured products. One reason people like mutual funds or other asset classes is because it's liquid in nature. So you have your money when you need it. And the fact that it's taxation which is fairly efficient. With structured products, those are the same strengths. I mean, is it as simple as that?
Rakesh sir is qualified to give this answer.
Well, I think that as far as taxation is concerned, the advantage of equity mutual funds, the tax advantage is slowly coming down. Now we are already at 10% tax. Structured products are 20% tax. So the tax differential, which was earlier 20, is now only 10. And I think that there's enough hints given to us that advantage is not going to be long lasting. Yeah. So I think taxation is not an overwhelming reason for not doing structured products.
Okay. And how easily and accessible are these structured products? I mean, it's not as simple as, you know, going online and buying them, is it?
No, I don't think so. And I think that
that's where the expertise comes in.
Yeah. So, and I think that these are niche products.
Yeah.
And therefore they need to be, as Feroze says, examined carefully before investing. But they exist.
And they're equally important to be part of one's portfolio.
To our belief, yes. Right. And therefore, you need to examine it and then take a call whether they serve your purpose or not.
Right, and I just want to talk about one more aspect of building your portfolio is sort of managing risk, right? We've talked a lot about risk in this conversation, any which ways, but any other mechanisms that one can, you know, attribute, plug into your portfolio, maybe hedge your portfolio, because there may be years where you won't get a 15% return, you may get a negative return. Of course, it will balance out over a period of a decade, but in that period, any way that one can sort of start hedging or looking at other instruments that may actually work?
That I think Feroze mentioned in the beginning, that there are instrumentation like LEAPs available to hedge your risks, and therefore...
And that's recommended too.
Absolutely. And I think that one should, you know, that's why I'm saying that when we construct a portfolio, it's not as simple as just doing
just add a few products and make it okay.
So you just, you know, go through the process. I think that's very clear. Have an objective and work through your strategy by taking these inputs and seeing as to what is the portfolio, what kind of safety do you want to put into that, what's the cost of creating that safety, is that worth it or not, should I do it now or later. So you have to work through all these details to create that strategy for yourself. And once you've created that strategy, then don't sort of keep questioning it.
While I know the investment time horizon is an extended period of time, how often should this be reviewed? How often should you look to adding and taking products in and out? I mean, of course, looking at your portfolio every day is not advisable. You might not even have the time to do that. But of course, at the same time, just leaving it for a few years and then going back and revisiting it is also not advisable, right? You've got to take this seriously at the end of the day.
Correct. I think review is a very important part of management. That's where the fourth step of management, which says you have to monitor relative to objective. See, if you're monitoring it without an objective, then you don't know what to measure it against. So review is critical. What's the frequency of review? in my opinion, a full detailed review of 1 year is very critical. Just having a look from an HNI perspective, having a quarterly look or even a monthly look at your portfolio to see if there is something which needs your attention. But a 1 year strategy review is very, very important. A full-fledged 1 year, one financial year's reviews.
And I know it's tough to say this out, but in terms of a lot of people, what they'll end up doing is of course, we believe in, spreading your risk out. Might go out and buy way too many products, even in the same asset class. That is, again, too much distraction for no real positive outcome, right?
Right. Statistically, there are answers to these questions. What is optimal diversification? Right? It says that mutual funds, for example, you should not have more than 7, 8 mutual funds. Because optically I might have 20, but if all the 20 are going to put it back into the Indian stock market, they're just optically 20.
Still doing
right?
Something, yeah.
So you've bought the entire market. Buying the market and beating the market is a counterintuitive thing to do, right? So there has to be optimal number of portfolio or optimal number of products in each category. Now, second is, especially when I see portfolios which are brought in a balance sheet form across 4 advisors, then automatically everybody is operating in a silo. There's no master advisor. There's everybody equals. So you will have to appoint somebody who is your CFO, right? That is when there is a bird's eye view of the entire portfolio, and otherwise you will sum it up and see there are 22 mutual funds. And it's very unlikely that you will beat the market by 4% because you have the entire market in itself. Because a 22 stock portfolio will have 700 stocks, right? That's a lot of stocks, right? You can't beat a 50 stock index with a 700 stock portfolio. That's point 1. Point 2, you should buy the same boring product. Now, for example, like we were on the topic of structured products, we are doing the 200 series of the same product because it's making money. So if it is making money, if it's on the same principle, because the client or the wealth owner always asks you this question, Naya kya hai? Right, that's not my objective, to give you something innovative. I will only innovate when the previous innovation is not making the objective. So everything goes back to objective. If my 15 is not being met, then I have to use my mental simulation to try and generate something which can bridge the gap. But if it's already being met, you should control the urge of not wanting something new which has worked. You should use the same one. So products should not be changed, and fewer products is the same.
One more product. One more product that I think a lot of HNIs might come across is PMS. So it's a cusp between direct equity and mutual fund. You always start believing that if you have somebody who's giving you that personalized attention, running a smaller portfolio, more concentrated, they may land up doing a better job. More often than not, they don't do a better job, and we all know that. But we always get tempted into trying this, right? Rakesh, I know you're a strong believer of boring mutual funds, so why don't you tell us why PMS should strongly be avoided, because I can assure you half the audience here might have invested in a PMS once in their life.
Well, that's exciting, and therefore you shouldn't do it. So I strongly believe that economic reasons will attract the best talent, right? So if, for example, there's a mutual fund where you have an opportunity for a fund manager to manage 20,000 crores, it'll attract the best talent. So if you have a niche PMS where somebody is running 200 crores or 300 crores, and if he's so talented, is he likely to be there? Or is he likely to move on to something more lucrative? So, I think you're just trying to second guess when there's no need to second guess, right? It's not really adding tremendous value, and at least the numbers are not sort of indicative of it. And therefore, go to the tried and tested mechanism of mutual funds. That seems to have worked the best, and therefore stick to it. And I don't want to look at anything else unless and until it beats what I'm doing. If it's not beating what I'm doing, I just have a sense that maybe this fellow will do best or better than the other. God bless him. I'm happy with this.
Very quick word on debt, because 30% of the portfolio is still recommended to remain in debt. What's the outlook on debt? Any sort of risk that one should keep in mind or be wary of while investing into a debt product?
Well, I think you have various kinds of debt products, but the purpose of debt is to bring some degree of stability to the whole portfolio. And that's why you have debt. because returns are predicated to what your equity markets are going to do. And therefore, again, the boring. Accrual funds.
I think Rakesh is not going to let me let go of that word now.
No, I'm not.
He's going to hold it against me.
No, I'm not. But I'm saying that there are simple accrual funds which accrue in the interest into the funds, and they give you in the range of 8-9% returns, and it's not sort of linked to interest rates going up or going down. It doesn't change the outlook to the return expectation. You don't want to play too many risks. On the one side you're playing the equity risk, on the other side you're playing the interest rate risk, then you're playing all kinds of things. Then you are reducing the chance of being near your 15%. So your objective is that you want to tread past and reach the 10-year goal, right? And if you have too much diversion in this whole process, the risk, as Feroze says, is that you'll go off the path completely, right? And if you are somewhere around the 15 number, your confidence in being on that pathway is that much higher, and you'll get there. So therefore, take the risk that is relevant, which will really get you to that 15, and this is not really relevant. So stay with accrual funds.
So realistic asset allocation expectation in terms of returns is about 15%, and 10 years equity is what I think we are all overweight on. And the best way to do this is through mutual funds. I don't think there's any arguing or denying that. I think we'll wrap this conversation here, and of course now we're ready to take questions from the audience, so we can start with that. Anyone who has a question, raise your hand, we'll get your mic, introduce yourself. Yeah, so I think the gentleman there.
Okay, now my question is, you say that real estate is going through a correction phase, whereas equities are likely to do well. So my family is in the real estate business, so it's not music for my ears. But I would like to know, how do you make that prediction? Because there is no statistical study as to how long a particular, this is going to last. Like, this phase. It can be, it might have been there for 3 years, and it might be good times for real estate. So how do you say that, how can you predict the future of real estate?
Wonderful. Shall I take this?
Yeah, of course.
So, predicting the future is about seeing the data currently available and not being biased towards an asset class and not being biased against it. For example, now when you speak of real estate, fortunately we had this call 4.5 years back. Okay, today it is not a debate. 4.5 years back we've written articles and have done TV interviews saying that you should, the last thing, it's so clear that real estate will not do well. And at those times, if you visualize 4.5 years back, the debate would go on for a couple of hours. Now there is acknowledgement. Why? Because data says there is 8.5 lakh apartments unsold with an average price of 80 lakhs. In a country, only 44,000 people have filed taxes greater than 1 crore. Basic economics, step 1. I'm not saying this is conclusive. There will be 10 steps to come to a conclusion. Step 1, basic economics says if supply is high, demand is low, see whether demand will return. Where will demand return from? If there are 10 lakh people filing taxes greater than 1 crore, I will say these guys can afford this apartment. But there are 8.5 lakh apartments, and these are the number of people who are filing taxes. Of course, there are several who don't file their taxes correctly, but let's go with data which is right. Point 2, if I get some data, there is another gentleman who will be called the RBI governor. He will have 10 times more data than me, 100 times more data, or even more. And that person actually concluded this. 3-4 years back, Raghuram Rajan, one of the smartest man, in my opinion, said this quote unquote, real estate is now in a bubble. Only fools invest in real estate, which is giving a rental yield of 2%, 3% at interest rates of 10. Now, if the same thing was said about equity, I would have got 500 calls the next day. It was said about real estate. Since our love is so much towards real estate, that we ignored that statement. So it was just a cut, copy, paste of his opinion. to create our opinion, for example. Now, third point, real estate is on the backbone of the world using, at least India was using 2 dimensions, not the third dimension. The world is a 3-dimensional world, right? It's not a 2-dimensional world. If it is a 3rd-dimensional world, now for example, if I give you Mumbai statistics, Mumbai is 607 square kilometers. Only 500 odd square kilometers of actual construction has happened. That means you have not even constructed 1:1. Hong Kong has constructed 3 times more than the land available. So now we are going laterally upwards. So you're literally creating supply from thin air, literally thin air, right? Anybody who has a 3-acre plot does not want to make a farmhouse today, wants to say, how can I build 40 stories here? So which could, a 2-acre plot which would house 4 families, 5, 10 families, now wants to house 1,000 families. Where will you bring the 995 families for every aspiration? So, and the 4th point is, every asset has to go through something called, the strongest theory as per me, which might not be, is called the base effect. Base effect, by which I mean 5,000 rupees a square feet apartment becoming 50,000 is 10 times. It is a certain return. Let's assume it became 10 times in 10 years. Good return. In the next 10 years, if it has to produce the same return, it needs to become 5 lakhs per square feet. It is very different for 5 to becoming 50,000. 50,000 becoming 5 lakhs is the same return in the same period, but the base effect is lost. So for example, if you take the largest company, okay, on the listed space from market cap, TCS doubling its profits is very different than Anand Rathi doubling its profits, because the base effect is there. So base effect is lost in real estate. So there are several, for the lack of time, when you are dealing with 70% of people's portfolios is in real estate. Okay, that's not funny. Actually, that's a huge amount of money in Indian. Now, globally, like Rakesh sir always points out, globally, asset allocation of HNIs is 18-20%. Indians might have some data to say it cannot be 18-20. We are more learned, and that's why we need to have 70-80, but we have not seen any data. Now, on the way when we were discussing, so you might want to give your apartments example of what return it turned out to be.
I've been in the city 18 years, and 2004 had some money, and therefore I could afford an apartment and bought it for 60 lakhs. God has been kind, and therefore I moved to a bigger apartment, simultaneously sold off my apartment, didn't keep it even for a day, and sold it off for 2.5 crores. That's a return of 10-11% in these 14 years. Now 60 going to 2.5 crores optically looks a huge return. But after all, we are in the business of money management. It's worthwhile doing an annualized return to see as to what return you've made. That simple math, I think all of us, our wealth is crying out and saying to us, please do simple math for me, please. And that we should do. And we are doing wealth management without doing math. And looking at 50 and saying, I've made 250, wow, fantastic. Please examine before celebration. Right? So I'm not saying do this or do that. But as I said, we can't predict. Sir, we can't predict. Our view is that it is unlikely to do well. Okay? And we may be wrong. For and there's a logic for it, which Feroze explained in detail. It is your money. You have to take a call. You may have a different view, and therefore follow a path which is different from what is being recommended.
Hi, my name is Jaykumar. Question, you talked about the market cap and GDP mirroring and it going from 2.6 trillion to 6 trillion. Now, we're seeing a lot of startups, and it looks like in the next 15, 20 years, there are going to be more opportunities in that area. Flipkart commanding $17 billion. Do you see the participation in the unlisted space, outpacing the participation in the market cap of the listed companies? Because we've seen a lot of old economy companies actually going down in value, and the disruptions coming from these new companies. So are you going to see shrinkage coming out of the listed companies today, thereby the opportunity actually going down, versus the new disruptor companies like, the Ubers and all of them, outpacing the listed space?
Wonderful. There are 2-3 parts to this question. One is to say, should there be inclination towards getting into unlisted? Of course, there are startups which have done immense value creation for the promoter, and unfortunately that promoter or the person who is invested is institutions generally. Flipkart has not taken money from individuals. Then for every Flipkart, there are 10,000 unsuccessful startups which don't show up. Right? You're only going to see that which actually made it. So if my money was in any of those 10,000, then I would have lost and come to near zero. So point one is, it is the survival bias, right? So you are only seeing the ones which survived. The sample size would be not correct, point one. Point two is, if you then said, my objective is 15, then I will operate at the least common multiple. If a client says, I have to make 25, then I will do this. If 15 is getting met, so all your actions have to go back to whether objective permits me to do this. If I'm meeting my objective, then I will not get into that. Reason being, now coming to whether these listed companies will lose its sheen and these can come over. 2 points to that. There is 250 companies, which are the top 250 listed companies, by mandate will get 5,000 crores of inflow every month. Can you believe it? So mutual funds get 7,000 crores every month as a systematic investment plan, not from rich people, from the lower strata, accumulated as 3,000 to 2,000 a month, and out of this 7,000, as per SEBI's October 17 circular, 80%, 70% of this money will chase 250 shares, right? Now, if that kind of liquidity comes, great. Now, the next obvious question is, how long will this 5,000 crores come, right? But if you know, in India, there are only 2 crore mutual fund investors out of 138 citizens, 138 crore citizens. And SEBI has mandated, unless it changes the rule, to spend 10,000 crores in the next 10 years. It has mandated spend so much money on investor education. What is the likelihood that this 2% or 1.5% of Indian investors will not become 8-10%? So the kind of domestic Indian savings which can chase capital markets, I would be surprised if supply can keep up pace with demand. Okay, spending 10, now you have all seen mutual fund Sahiye campaign. Where does that come from? 430 odd crores is being spent this year. At the cost of you and me, 0.02% of existing investors' money is debited every year from 2013 to educate the newer investors. That's why today my driver does a systematic investment plan and I didn't have to prompt him, he asked me. Right? So if that kind of Indian household money can chase, the next 10 years liquidity will be driven not by the Gora, by the Indian domestic household savings. So I'm not too worried about supply being too much, but you're absolutely right. There will be emerging companies, but they will emerge as mid-cap and small-cap, and they will come into listed space, because every institution which invests in a startup wants to understand how will they exit. The exit route is public, right? So even a startup will come into the public domain. Of course, that will create supply. So that's the point. You're absolutely right, but there is so much entrepreneurship in India which will actually emerge, and they will contribute to the supply of the listed space, because that's where an exit comes from a foreign institution.
And that's what we'll wrap up.
Thank you so much.
Very much.